All righty, folks. Do you want lower interest rates? I think most of us do, especially us in real estate. I want to talk about the two ways that we should be watching and seeing if we can get lower interest rates. The first one's very simple. I shared with you weeks ago, one of the core elements of the US economy, and frankly, world economy, is oil. We need to get oil down to $60 to $65 a barrel. That will be net positive for inflation. The second one, very specifically to the United States, is we need to attack what is called the term premium. What does that mean for us average people? Well, that means that the Fed has cut rates 100 basis points, but the long end is up 100 basis points. Most people don't understand that is most likely because of term premium or perhaps inflation expectations. We're going to have this conversation with Taylor from Life Goal Investments because I want to break down two things that are happening right now that almost nobody understands that could dramatically impact the term premium. Taylor, how you doing, buddy?
Doing great. It is an interesting event when you see the Fed cutting rates and then mortgage rates going higher. It confuses the average person, and the concept of term premium also could be referred to as steepness of the yield curve, which is another way that nerds like me on the bond end up looking at things. But I guess I'll frame it with saying this, and then I'll hand it back to you. When you think about the yield curve and you think about treasury bonds, you think about 0 to 2 year treasury bonds, typically that's thought of what the Fed can directly influence themselves. Correct. When they cut rates, typically out to 2 years of treasury yield, the yield will come down on them, driving the bond prices higher. Anything beyond 2 years, call it 2 out to 5, 7, that's the belly of the curve. And the back end of the curve is 7 years plus. Mm-hmm. The back end of the curve is incredibly sensitive to one thing. You could kind of put two things in there saying GDP, economic growth, but realistically, it is inflation. Yeah. And so I'll hand it back to you, but inflation worries or concerns have been what's driven the back end of the curve higher, which has taken mortgage rates higher as the Fed's cut on the front end.
Yeah. So again, oil will be helpful.
Totally.
But if we don't attack the term premium, it really doesn't get all that better. Mm-hmm. So I want people to realize that this game of impacting the term premium is really only about bending the curve. Oh my God, I just had a flashback to COVID, bending the curve. Remember all that? How scary that is. Oh, yeah. But what do I mean by bending the curve? If you look at our national deficit, it is increasing at an exponential rate. And it cannot continue at this rate forever. It will implode. The empire will blow up. So what I think is going on right now, and it will take likely years to make happen, is we need to bend that curve. We need to stop this ever increasing cycle of deficit, and we need to somehow bend that curve. It doesn't even have to go negative, but if it goes negative, all the better. So I believe there are two things hard at work right now. And if you guys don't know, there's only two inputs to government deficit. It's nothing more than income and expenses.
Correct.
Whack expenses, grow revenue. It's just like your home budget. The national budget is the same like your household budget, except they got an unlimited credit card. That's the difference. So when I'm looking at what's going on right now, we have two things that everybody who wants lower rates should hope work. So what are we doing to potentially increase revenue? Well, if you guys aren't paying attention, over the weekend, there were these things called tariffs, potentially levied against Mexico, China, Canada. And let's be clear, lots of more tariffs are coming. Tariffs are a way to increase revenue. Taylor, I'll stop there. Am I fair so far?
It is, absolutely.
Okay. So that's step one. I do believe when we look, if we fast forward to December 31st, 2025, we will have probably lots of very focused tariffs, and those tariffs will collect billions of dollars in new revenue, in my opinion. So that's increasing revenue. Now, how do you tackle lowering expenses? Well, it's been reported. I've not validated. I can't validate this. But DOGE is already saving about $1 billion a day.
Interesting. Now, I hadn't seen that.
Yeah, $1 billion a day. And apparently, they have line of sight to $4 billion a day. Now, if you take 4 billion and you multiply it by 365 days, you actually get $1.46 trillion. So let's round it to 1.5. So again, if you increase tariffs, revenue by hundreds of billions, and you effectively whack $1.5 trillion in expenses, you have bent the curve, and the term premium will collapse and the long end will fall. So I do not think people understand the power of tariffs and DOGE should they work to increase revenue and whack expenses. I'll shut up.
Yep. No, I think it's an interesting perspective. I think where I'll push back on a little bit of the tariffs is just the unknown nature of them. So if all else remains equal, where we continue to consume the same number of goods that are imported that are collecting a tariff from the external country, wherever we're tariffing, then all else being equal, obviously that's additive to our budget concerns and brings down the overall deficit that we currently run on an annual fiscal basis, like clockwork, unfortunately. That is the big unknown. I think how does the market react to, in all likelihood, higher prices on these goods as tariffs get imported or as tariffs get in placed on them? That will drive up prices. Do we continue to buy? If we continue to buy and can afford to continue to consume those goods, then yes, that is certainly something that will help our budget deficit. If the prices go too high, we can't afford to, then that doesn't do as much. And then on the other side is like a household. Hey, can you make more money? I don't know. Can you cut expenses? Yes. And the short-term impact of cutting expenses is undoubtedly dropping to the bottom line. The longer-term impact of cutting expenses is the unknown. How much impact does that have on a society and a country where the government's been the only additive employer over the past 2 years? Does unemployment start to move higher? Do people have less dollars in their pocket to spend? That's the unknown.
Yeah. Again, this is the chess game, right? We have to bend this curve.
Totally.
Right?
I don't. Yeah. So I candidly, I don't think we have. It is very, and I don't think you're oversimplifying, but it is very, very, very hard to bend that curve. To state the obvious, it is a macroeconomic global environment that dictates where the long end rates are, and then from there, it's Anyway, I'm just making the point that this isn't something that's easily done.
Yeah, and to be clear, this is why I am calling for mortgage rates to average 7% in 2025. I see all of this stuff going on, but all of these things going on won't impact in the short term. And short term in this analysis is a year, right? This is, 26, 27, 28.
Yep.
But again, this is it. We have to bend the curve. It doesn't have to go negative. It's just got to freaking slow down. Hold on. Then, by the way, if the long end rates fall, guess what happens?
The budget deficit comes
down.
The
budget deficit falls because what is a large, like $1 trillion additive today? 5% interest rates.
Right.
If that suddenly becomes 3.7, net positive again. We raise 100 billion. We whack 1.5 trillion. Rates come down. Suddenly we have a surplus, folks. Now, again, not 25, maybe not even 26, but by 2027, we could theoretically have a budget surplus. Yeah. That is possible.
Yeah. So to take the mystique off of what you're saying, when you're talking about bending the curve, all you're saying is bring down inflation. That's what you're saying.
That is the outcome of this. Yes.
Correct. Yes. So what we're talking about is bringing down inflation. And I think that puts it in a little bit more tangible terms. And I think people realize that has been a tougher battle that's been waged. And we've tried to pull on a lot of levers. It'll be interesting to see. I would love to see it. But the more you start pulling on things, the more gyrations start to take place. So like right now, the Fed is in a cutting cycle. Inflation is moving against us, right? It's moving higher. Raising rates certainly doesn't help that. No. And I say that, but and then counterpoint to that is the front end of the curve doesn't dictate the back end of the curve. So last time we cut rates, what the market said is there's more easy access to capital, and the back end of the rates went higher.
Yep.
So it's interesting, though. Inflation is the long-term driver of the curve, and the ability to dictate the direction of inflation has been one that's proven challenging for our monetary and fiscal policy.
Well, let me ask you this, right? Do you think bending that curve at some point over the next decade is a requirement? Can we just keep running these 2 trillion
Yes.
and 2.5, and we have to do it, right?
Yes. But I think that what comes along with bending the curve, in all reality, historically tells us, is economic duress. So it comes along with the economy slowing or us stumbling into a potential recession. That'll bring rates down. That'll bring budget deficits down. That will bring down asset prices in general.
Yeah. It just has to happen. Right?
I agree.
Ray Dalio has been on this topic for a long time. I think he just released a 3rd book or something that I haven't gotten yet. But this, if this continues, this is empire collapse, territory if this just keeps going that direction.
Yeah, we were at this point just post World War II, so we've been here before. The difference then, the real problematic thing right now is that we have taken our budget deficit where it is when unemployment has been remarkably low.
Right.
And that is a problem. Is okay, if we hit a stumbling block when you should be incurring debt to stimulate your economy, how do we incur more debt than we currently are? That's the big question that's outstanding, that hopefully we don't stumble upon it. Hopefully tariffs and DOGE in their own right have the ability to tariffs generate tax receipts, and then DOGE cut spending on the other side without hurling us into a recession. Those are 2 levers we're messing with right now, and it's an experiment. Let's be frank on that.
Well, again, I think it's just like your household budget, right? If you're $30,000 or $3 million or $30 trillion in debt, you only got 2 choices: increase revenue or cut expenses. And I think what you are seeing, it's only been, what has it been? Not even 30 days in office. I think it's not even been 2 weeks, maybe just over 2 weeks.
Yeah, I was going to say, the 20th or something like that.
It's only been 2 weeks. So again, I guess it's been exactly 2 weeks. That's what they're doing. That's the game that's being played. And this, again, is not a 2025 goal. This is a 26, 27 goal.
Yep. Yeah. And I think that it's unknown right now. So I think there's going to be a period for the markets where there needs to be some digestion. And there has been, frankly, zero digestion. There's been a little bit of whipsaw in the last couple of weeks. Yeah. But moreover, since Trump trade set in September of last year, people said, we like the economic outlook. We like the pillars of what he has. And therefore, it should be stimulative to the economy. But we're also talking about, at the same time, cutting spending, which cutting spending is not stimulative to the economy, but it needs to happen. And I'm not saying anything against that. It's just the battle that we're waging now.
Yeah, it's going to be really interesting to see where this goes. Again, I think the chessboard is the right analogy. We don't need to worry about individual pawn moves or rook moves. It's the bigger game. What's the game? Make America stronger at the end of 4 years. That's clearly the goal of the administration, whether you had voted for him or not. That's what he wants. And I think all the moves he's doing is looking at that as the answer.
Yeah, no disagreement here. We'll see how well the tactics play along the way. I think that you're gonna, inevitably you're gonna hit stumbling blocks. We're making really hard decisions that have needed to be made now for an extended period of time and have just been pushed further and further and further out and kicked the can down the line. Now, hopefully we're addressing these, and it's going to come with some consternation. But at the end of the day, the alternative is non-existent.
Yeah, we don't want the alternative. Taylor, you got to do a lot of crazy stuff. You're reacting to these different moves each and every day, helping people understand their portfolios. Where can they follow you? Where can they reach out?
Yeah, follow us at Life Goal Investments. We're on both Instagram and TikTok at Life Goal Investments. We do 60-second daily videos. And then to reach out to us, we run a wealth management firm. So for our services, the link is right there. It's lifegoalwealthadvisors.com/introduction. And you and I will chat.
Thank you, buddy. Take care.
Appreciate it.